Will the Fed and U.S. inflation data light up these markets this week, or have we already priced in everything there is to price? And is this now just waiting to get to the other side of event risk? That's the question that is first and foremost at the front of the market's minds this week. And that's what we're going to tackle here today. I'm Ilya Spivak, head of global macro here at tastylive, and this is Macro Money, a little show where we like to delve into the macro narratives underpinning financial markets and try to figure out where those narratives might set the market's lens on how to interpret incoming information. After all, nobody can tell the future, but we can look at how the price action responds to what is occurring and then surmise, or at least hope to surmise, what the market thinks as a consequence. And of course, the operative question that we have been fighting to understand really since the start of the major equities rally, now with us since late October, early November of last year, is how much does money cost? That has really been front and center. And the market has, of course, demonstrated that it likes for money to cost less. No surprise there. And so the equity space and risk assets in general have celebrated the prospect of more Fed rate cuts. After the Fed signaled it was probably done hiking in November, kicking off that rally. And when the stock of rate cuts seems to diminish, the markets get a bit wobbly. So we'll take a look and see if perhaps that calculus is going to get reset again this week, or if the markets are at this point on something of a glide path. And let's start that conversation by trying to figure out what the markets did last week and what that might mean as stage setting. Here's the major assets performance last week, and we can see the push higher here from the S&P, push higher from the NASDAQ stocks having a fairly good week last week, 1.1 on the S&P, 2.4% added on the NASDAQ, essentially rebounding from the prior week's weakness on S&P, and very little changed, ultimately pinned to last month's highs, and actually breaking those highs on NASDAQ, extending higher, but struggling to sustain momentum after an initial push higher. Most of those gains in NASDAQ scored earlier in the week last week, and the latter half of the week spent largely thinking about economic data that ultimately doesn't give a further clear lead. But perhaps the most interesting bit for these markets in looking at the price action last week, it wasn't gold, which kind of moved around within a range that it has occupied for a few months. It wasn't crude oil, which seems to be, as ever, marching to the beat of its own drum here in certainly since the beginning of this year. And of course, that 1.9% sell-off that we saw last week has since been almost thoroughly erased, because there's been a bounce here at the start of this week of some consequence. It's actually what's going on in bond yields. And here the situation is particularly interesting because the long end looks quite different from the front end. That is, longer term maturities saw rates decline, the 10-year rate down 1.5%, the front end holding steady, as if to signal that what we got last week wasn't so much a shift in how many Fed hikes we will get or won't get, that it wasn't a sort of uniform shift across maturities, that the market didn't go from being more hawkish to being more dovish in whole, or the other way in whole, but that in fact what actually occurred was a flattening of the yield curve that signals perhaps that maybe the Fed has been right all along, that maybe what is incoming for markets from here is a downturn in the business cycle. The Fed, of course, has been frustrated by a slowing in disinflation since the beginning of the year, saying that rates, nevertheless, are still restrictive enough or will be restrictive enough that further hikes are not necessary, and trying to walk a fine line between saying, well, we don't feel confident enough to cut now, but we also don't feel like it's necessary to hike at this stage, that rates will ultimately be high enough to squeeze enough of the economy to push the remaining bit of inflation in excess of the 2% medium-term objective out of the system. And of course, the markets thought the Fed was initially wrong and too hawkish at the start of the year. The Fed was at 3 cuts for this year. The market was at 6. Going into March, the latest update from Fed officials, that calculus started to significantly flip over. Now the market is nominally at a more hawkish setting, looking for 1.5 cuts this year, leaning toward 1, slight possibility of a second. Whereas the Fed, because they haven't updated their official standing since March, is still at 3. But perhaps the actual situation is such that the Fed is right. And that it's not that they had too few cuts before and too many of them now. It's that perhaps the downturn they've been waiting for is now actually arriving. Or at least that is perhaps what the bond market is starting to sniff out, especially after last week's economic data that gave us an ISM survey that seemed strong, but the markets didn't necessarily run away with thinking it would be inflationary because employment and the price component within it weakened. And then a jobs report that seemed strong, but most jobs came from part-time employment, full-time actually fell. And again, you got this sense that under the surface, there is a turning of the business cycle. And it is with that we look at this week's news flow. We begin, of course, with that conversation about disinflation as we get the May set of CPI data. That's coming at us the very same day that the Fed will announce policy this week on Wednesday. The expectation is that the headline reading will remain unchanged at 3.4%. That's the same reading as we got in April, but that the core measure, which is something that much more central to the Fed's thinking because it encompasses that bit where inflation still remains, mainly the service sector. As we can see here, inflation is now made up of a slight bit from food, as a slight bit from energy. Goods are now an actual downdraft. They're a negative contribution to inflation. We can see that at the bottom below zero there. But the main chunk of the inflation that's left is service sector, excluding food and energy, which generally is this core reading. And you can see as this flatlines here, this has been flatlining a bit as well. On that measure, we're expecting to see 3.5% year on year, which would be a 3-year low, a little bit more than a 3-year low, the weakest since April of 2021. Now, If we look at the makeup of the change that we last saw here, there was a very helpful downtick at the headline. And encouragingly for Fed officials, the downtick at the core was even larger. This is, of course, exactly what they want to see. Moreover, the bulk of that downtick seems to have come from the services side, which again is exactly what the Fed would like and exactly where they want to be going. So it is encouraging here what seems to be occurring, at least in last month's dynamics. And the survey data we've seen since then, be it the ISM data, be it the S&P Global version of the PMI data, does seem to suggest that there's maybe a bit more that's been achieved here in the core part of the inflation story in May. Having said that, the calculus for Fed officials is one of confidence building. And everything that we've heard from Fed officials in recent months has been, well, we think this is going to work, but we don't have the confidence to say for sure, and therefore we're not going to cut. We don't feel like we are on a glide path to 2% here. We don't have enough confidence in that as a premise to keep going into a stimulative direction. And so this is where things get tricky. Because if you look at what inflation has done over recent months, there's a very clear stair step lower here, February, March, and April. We can see the month-on-month changes in both headline and core here. This is headline CPI, this is core. And what the Fed likes to do is to take the 3-month and the 6-month annualized changes and see how we're pacing and whether we're starting to pace in a direction where over a 3-month window, the annualized rate is coming down. Over a 6-month window, it's coming down. And as it turns out, it isn't. Or at the very least, there isn't a clear consistency. Now, when we look at the core 3-month rate, we've mentioned here that the Fed is mainly focused on the core because that's where most inflation is left. Here's the core 3-month rate here. That's the yellow bars right here. Notice what we've done since January. So we had been going up all the way through March. We ticked a little bit lower in April. So at least 1 month in the right direction here. Take a look at the 6-month core rate. It is higher in February than it was in January. It is higher in March than it was in February. It is higher in April than it was in March. So to put it simply, we are going the wrong way. There's not that compelling of a reason here to say, absent 1 month's data, things are moving, or at least they've resumed moving the Fed's way in a more confidence-building kind of way. It's a similar story at the headline, where we can see the 3-month annualized change at the headline is not really coming down in any kind of a meaningful way. And the 6-month change is actually rising from February to March, and certainly from March to April as well. It's really just the 3-month core that's giving us a bit of a hopeful sign here. So whatever happens with this inflation report, chances are it is unlikely to build any more confidence for Fed officials. With that in mind, there is the Fed policy announcement itself. So we can see we are looking at this stage for the Fed to reduce rates by a cumulative 1% over the course of this year and next. And the way that this breaks down here is there's going to be 1 cut this year, give or take. That's the gray bars here. And 3 cuts next year. That's the yellow right here. That's their sum. We can see that as this cumulative tally has moved, so too have stocks. When stocks reach their most recent bottom, this tally started to expand back out. When it stopped expanding out and found something of a level of support, stocks stalled. They now are hovering sort of near these highs. And we're going to attempt to figure out if they're going to reverse lower from here based on what the Fed guides, or we're going to extend further higher. And that, of course, comes down to this calculus. Looking at the path forward this year, we can see the first cut is going to occur here somewhere between November and December, as far as markets have it. So we can see no cuts here through July. You're starting to get a little bit closer in September, but it is not a significant shift, a mere 6 basis points. By the time you get to here, in November, the likelihood is starting to get closer to actionable. And then, of course, by December, the cut's there. This is the part of the conversation that is most likely to be impactful. Note what's going on here. So if we consider that the current baseline rate is a median of 5.33, so that's the midpoint between 5.5 and 5.25, then the amount of easing that the Fed is looking to do here this year and next, in all, is about 1.43%. So anywhere between 5, which would be 1.25, or 6, 1.5% in cuts. Looking at the out year here seems a bit presumptuous, so it's unclear that this is market moving at all. But we know that the Fed didn't make any adjustments between December and March, but has since at the May meeting told us they're so very frustrated with disinflation stalling, and all the rhetoric from Fed officials suggests this sort of higher for longer stance. So it would be very much baseline, it would seem, that this number is going to get diluted. And we're going to see this adjust to a higher setting. So rather than it being 3 cuts for this year, it might be more like 2. So we might see that number come up to, let's say, 4.8, 4.9. And then, of course, the question will be, do those cuts then migrate to 2025? Because again, if we look at where the markets are currently, the last Fed update gives us 1.5%, let's call it, in easing. And we are now at 1%. So the market is 50 basis points, give or take, more hawkish than the Fed. If the Fed then gives us a tally here that's maybe 1.25% more hawkish relative to the market. In other words, we shave a cut here, but maybe that cut moves into here, or maybe we only shave one cut here and this stays unchanged. And we end up with the Fed saying, all right, we had to lose a cut. Now we're going to be at 1.25 over 2 years versus 1.5. Well, that would mean the market is still a little too hawkish. That would give stocks something of a tailwind, suggesting the Fed is not prepared to quite go as hawkish as the pricing in Fed funds futures would suggest the markets see things. If, on the other hand, the Fed moved such that it was aligned with markets or even pushed to something that is suggesting the markets haven't made enough of an adjustment, that would probably be stocks negative. But of course, the way things have evolved, the data seems to suggest maybe the Fed is in fact seeing what they want to see. That maybe the labor market is starting to soften. that maybe inflation is starting to show signs that ultimately it will be responding to these higher rates. It just might take longer than the Fed initially anticipated. And then the question will be whether investors are prepared to cheer that. Because if the Fed is more dovish because the business cycle is turning, as the flattening of the yield curve last week seemed to suggest, well, then you get into a place where the markets have to decide, are we in the first quarter where there were many rate cuts coming and growth was accelerating, which is an understandably Goldilocks environment for risk, or are we someplace else where the rate cuts are coming, but they're coming in an environment where they're actually needed because growth is weakening? And whether that is still a positive story for stock markets. To inform that view further, and a bit ahead of all of this Fed guidance, we're going to get inflation data out of China as the last bit of key macro risk this week. And here the expectation is that we're going to hold steady on CPI, 0.3%, so just a touch above zero. And where the PPI component, the wholesale inflation component, nudges up just a hair, but stays in negative territory to the tune of 1.8% year over year. If we look at the way that Chinese economic data has been developing relative to forecasts, this is as ever data from Citigroup, we can see that Chinese economic data has actually been deteriorating for the past month and some change relative to forecasts, and is now basically back to zero on this index, meaning it's in broad alignment with forecasts. If this sets the stage for a situation where we're looking at maybe a slight miss on this inflation data, or even something generally in line, then we still have this anemic situation in place for the world's second largest economy. Notice here, in the yellow is nominal GDP, in the red is real, and these are growth rates year over year. And then in the bars is the spread between the two. Note, real GDP is now north of nominal. And there is, for 4 consecutive quarters now, a negative coefficient on the spread between them, which implies a deflationary downdraft to the tune of about 1.5 percentage points of GDP growth, which is staggering. It is speaking to effectively the total absence of demand. When things are on discount, it is not because there is a rush of people urging or rushing to buy them. It's because there's not. And things have to be marked down to try to induce that demand. Only here it's happening at an economy-wide level, which of course would be a very scary story if in fact the US is actually starting in on an economic downturn, because effectively what this would mean is that there is no safety net from the world's second largest economy to offset. And then indeed the conversation for stocks might be, well, sure, the Fed could be cutting more, and we might have cheered that a few months ago, but with an anemic China, a downturn in the US business cycle, and a Europe that is still struggling to recover after last year's recession, shallow though it was, rate cuts aren't necessarily a good thing. They are a sign that earnings are about to get hit by a recessionary sort of shift at a global level. And that, of course, would make for very different dynamics into the second half of the year than we saw in the first. And that is macro money for Today, as ever, we are here Monday through Thursday, right after Overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where it might lead thereafter. Back on with Chris for Futures Power Hour on Fridays, on with Victor Jones for The Price of Truth on Wednesdays, back on with Victor for First Call on Sundays, along with Tom. Writing for the News and Insights portion of tastylive.com, and opining on the platform formerly known as Twitter at Ilias Pivak. Thanks very much for joining. Macro Money's back tomorrow.